Hey, welcome back. Today we're talking about what is secondary financing in real estate. All right, so on today's video, we're going to take a deep dive into secondary financing in real estate with a specific focus on second mortgages, because that's typically what most mom and pop real estate investors are going to be doing. So we're going to be looking at the risks and rewards of this, what it is, how it works, and how you can benefit from bringing on private investors to do this kind of secondary financing. Okay, so first things first, what is secondary financing? Well, secondary financing is anything that you do after you've got your initial mortgage, your initial primary financing on a property. It can be a second mortgage, it can be mezzanine financing, it can be preferred equity. And for the purposes of today's video, we're going to really dial it in on second mortgages. So what's a second mortgage? Well, a second mortgage is exactly what it says. You've got a first mortgage on your property, usually with the big bank, and a second mortgage comes in after that, where you're using some of the equity that you've got on top of that bank financing for that second mortgage. So it is in second place behind the first mortgage. So what are the big benefits of having a second mortgage? Well, there's lots of them. This is a way for you to pull out some of the equity that you've got in a property at a much lower interest rate than you might be able to do otherwise. So this is a great way for you to be able to pull out some money from a property to do renovations or to go buy a different property or something like that. That's the best idea for that, especially if you're an active real estate investor, is to be able to recycle your down payment. So what's an example of this? Let's say you've got a $400,000 property and you've got a $300,000 first mortgage on that property. That means you've got $100,000 of equity in that property that's just kind of sitting there. Well, now that's great, but you're not able to use that unless you access it. And one of the best ways to access that is through a second mortgage. Now, if you can get that through the bank, great. However, the banks tend to be pretty fussy about how much money they'll loan on a property. They've got a certain loan to value that they're comfortable with, and that's usually around the 70 to 80% range. So in this example, we had 75% loan to value. We had $300,000 mortgage on a $400,000 property. So in that case, a bank would probably not do a second mortgage on the property. So that's why we're going to have to look elsewhere. So what kind of second mortgages are there? Well, there's two main kinds of second mortgages. If you're working with a bank, you can get one of these two kinds. You can just kind of get a lump sum second mortgage where they'll put that second mortgage on the property and just give you a big chunk of cash, which is great. You can go out and you can do what you need to with that. Or the other kind of second mortgage is a HELOC, a home equity line of credit. So this is really cool because you only use that money when you need it. You've got availability, it's a line of credit, but if you're not using it, typically you're not paying on that, but you're able to access that very, very quickly. Now, those are the kind of second mortgages that are typically available with the big banks. However, if you're working with private lenders, private investors, like we're going to suggest, chances are you're just going to be doing the lump sum kind of second mortgage. They're probably not going to be comfortable with doing a home equity line of credit. Now, another big benefit of doing second mortgages is quite often the interest on that second mortgage is tax deductible, especially if you're working with an investment property. So keep that in mind as well. All right, let's take a look at what are the risks of a second mortgage. Well, for the lender, there's a bit of a risk when you're doing a second mortgage. So for example, if we've got that $400,000 property and you've got a $300,000 first mortgage on that, and let's say you get a second mortgage to access the $100,000 of equity you've got there, so you've got a second mortgage for $100,000, that means that the person or the institution that gave you that second mortgage, if you stop paying, they're going to have to foreclose on the property. They're going to have to pay out the first lender that had $300,000 mortgage with you in order to get their $100,000 out of that deal. So it's risky for the lender. It's a little bit riskier for them. And as far as you, what's the risk for you as the active investor with doing a second mortgage? Well, basically, the biggest risk is how much money or how much interest you're paying on that second mortgage. So for example, if you've got a rental property, and let's say for easy numbers, you're cash flowing $400 a month on that, and then you get the second mortgage on that property, and your mortgage payments on the second mortgage are more than $400, well, now you are negative. Now you're having to come out of pocket to pay for the first mortgage and the second mortgage, and that can get you into deep water very, very quickly. So you have to make sure that you're very, very aware of how much is the money going to cost you. How much is that second mortgage going to cost you in the long run? Now, one of my favorite sources for doing these kind of second mortgages are private lenders. Private lenders are fantastic because they're very excited about getting an above average return on their money that's backed by something solid like your piece of property. So they're very, very open to looking at doing a second mortgage on one of your properties because, again, what they're getting at the bank or what they're getting in mutual funds or what they're getting with their IRAs or their RRSPs in Canada probably doesn't even come close to what you're going to be paying them as a second mortgage holder. So I highly recommend that when you're looking for second mortgage holders, you're looking for somebody to do a second mortgage with, make sure you look at private lenders in addition to the big banks. Now, quick tip for you. I talked a little bit about IRAs and RRSPs in Canada. These are individual retirement accounts, and people literally, cumulatively, have trillions of dollars of money in these accounts. And if you look at it, most folks are not doing very well with the returns on that money. They've got it stashed with a financial advisor. The financial advisor and their company are charging fees. Whether that person is making money or not, they are getting charged fees. So if you're able to educate people about what a second mortgage is, about what a self-directed IRA is or a self-directed RRSP in Canada is, you will be able to bring people on, bring their capital on into your deals and have very, very flexible terms, unlike if you're dealing with the big banks. So this is one way that you can get up to 100% loan to value. You just have to explain to people exactly what the pros and the cons are so they understand exactly what they're getting into. Now, here's a quick tip for you. If you are talking to people about switching their account from a regular IRA into a self-directed IRA or a regular RSP into a self-directed RSP, you need to let them know that their financial advisor is going to do everything they possibly can to dissuade them from doing that. I mean, this came to light just a few days ago for me. I was talking with a client of mine, and he was talking about a deal he just lost because the investors he had lined up were going to take their IRA money and start using it with his deals. They had their retirement money with an advisor, a financial advisor. They had several $100,000. They were going to take it out, open up their own self-directed IRA, and invest it with my client, Jake. So he was thrilled. They were thrilled. However, Jake made a little bit of a mistake. He did not prepare them for what was going to happen with their financial advisor. So when they went and they told their advisor their keen idea that they're going to take control of their own money and and invest in real estate, well, guess what? The financial advisor freaked out. Probably didn't show it, but inside he freaked out, and he talked them out of it. He convinced them that real estate was way too risky, that they'd be taking a big chance, there was a big chance they're going to lose all their money, that they were much better off to leave their money with him so that he could manage it for them. So he made it sound like a big hassle for them to do that, et cetera, et cetera. Bottom line is they got scared, they got spooked, and they did not take their money and invest it with Jake. Jake could have avoided that if he had explained that scenario to them up front and let them know exactly what was going to happen. Because we have to step back and think about it from the financial advisor's point of view. What's happening? He's watching his income disappear. That $300,000 or $400,000 that they have invested with him is generating him a lovely residual income, because whether he makes money for them or not, every single year they're charging fees on that money under management. So of course it was in his best interest to talk them out of that. So when you start talking with potential investors about investing their retirement funds with you, always, always, always keep that in mind. If you're looking for a proven way to attract investors and joint venture partners, I've got just the thing for you. It's my book, The Money Partner Formula, and the price is right. It's free. I'm going to put a link in the description below, or you can go to investorattractionbook.com. And this is a perfect way for you to attract these kind of investors, these kind of folks that have lots of money in their IRAs or in their RRSP funds, and be able to show them a better way to get a much higher return on their money by investing in deals with you. So again, go to investorattractionbook.com, get your copy today.